It's good to see you guys again. In today's video, I want to go over 7 mistakes that a lot of beginner investors are making. These are mistakes that I was making as a beginner too. And sometimes I always go back. I have it written in a document where I read it once a month just to remind myself not to keep making those mistakes. Even if you're an experienced investor, you might be making these mistakes too. So I just want to share with you guys my mistakes that I was making. Hopefully you guys learn from my mistakes and don't lose a lot of money like I did. Welcome to SimpleChew. I'm your host Hank, and if you're into investment education, resale education, or any types of account practices, I suggest you to subscribe as I deliver videos every Mondays and Fridays. I think the first mistake that a lot of investors do, or beginner investors do, is that they don't invest at all. They go through a bunch of platforms and just see the stock market. They're just watching it but never wants to put their money in. They just want to develop fake profiles and portfolios and never want to get in the game. And I think that you miss a lot of opportunity not being in the game and just contemplating to get in. It's like reading a book about riding a bicycle but never actually going on the bike. As long as you're not in the game, you're not gonna learn anything, or you're not gonna make any money at the end of the day. I think it's really important to jump in head first. You know, I remember being in the pool and trying to dip my toes, and that never worked. So by the end, I was just, as soon as I got into the pool, I just jump in. And I think that investing in the stock market is the same way, where you cannot watch it from afar and think that you're making any progress. The second mistake that a lot of investors make is not having an emergency fund. I think I always talk about this on my budget type of videos, where I suggest people to have a certain amount of money saved up, their safety net, just in case they lose their job, they lose their business, or their side hustle is not working. It's always advisable to have at least 6 months of emergency funds, you can call it, but it's just for your essentials, so you can pay your rent, your mortgage, or whatever, and your bills. It's just so you can stay afloat into your next job, your next opportunity to make some more money. You don't want to start investing in the stock market and then you find out that, oh, you need the money because you need to pay your rent, or you need to pay your mortgage. It's something you want to have it covered, so your stock portfolio is well funded, and you don't have to worry about taking money out of it and selling your stocks and then losing future earnings. The third mistake is waiting too long to get in. I think that is almost as the first mistake, where you might see a big dip in the stock market and you don't want to get into it because you might think that it's gonna get even lower, and that's a possibility, that's a risk that it could happen. But just waiting to get into the market is just a mistake. Even if you get in where the market is so high that it's overvalued, it's still a good time to get in, because after a couple of years, your portfolio is going to balance out to the average of the earnings that you potentially can earn. I think at the end of the day, I don't believe that there's a good time or a bad time to get into the stock market. As long as you have your expenses covered, and you have your financial fund, your emergency fund set up, I think that there's no bad time to get into the stock market. I think it's more important to get in the stock market than just waiting around. The fourth mistake is investing way too much money at the beginning of your journey. I think I made this mistake in the beginning, where I have all this money, this bunch of money saved up, and I was ready to invest. I was really like eager to put my money in the stock market, and I wanted to put it all. And I think that's a huge mistake. I did it. I actually put all my money at once, and it's just not a good idea, because you want to invest slowly at the beginning, where if the market is so overvalued, you don't want to put, let's say, 10 grand in it, and then a couple months later there's a correction and now you lost half your money. What you want to do is, you want to put, if you have 10 grand, you want to put like 2,000 in the beginning, 3,000 in the first month, and then you wait another month and you put another 1,000, because you're waiting for that correction, so your average cost, your portfolio will balance out, and then you be in the average earnings where everybody's mostly in the same pace. But I'm talking about if you're investing in index funds. If you're investing on individual stocks or individual companies, that's a whole different story. I'm just gonna be comparing if you're investing on the S&P index fund or the DASDA, but I'm just gonna focus on index funds. The fifth mistake that a lot of investors do is not investing enough money in the beginning also, or at all, as they continue to run their portfolio. They did not put in the enough money that they will need in the future for their financial needs. I think a lot of people who are in the stock market are either waiting to retire, they're working on their retirement fund, or they want to buy a house, or they want to invest in a business, so they put it in the stock market so that money can grow. And I think that's a goal. You need to have a goal once you get into the stock market where, okay, my goal is to do this and that, and then you put enough money in that stock portfolio where you are going to be able to achieve that goal in a specific time frame that you want. And I think that a lot of people just go into it really vaguely and just really passive. They don't want to work in a goal, or have a set goal, or set any type of parameters where they want to achieve their goals. I think these people just go into it, and when you go into in that mindset, you're gonna lose focus. You're gonna lose the purpose of why you're investing. I think you always have to have that goal, so you know what you're working for. Because at the end of the day, you might feel like, oh, the stock market, this stock portfolio is worthless. It's not doing anything for me, and I just want to get out. And then you're losing a lot of financial opportunities if you do that. The sixth mistake is not considering the taxes of your stock portfolio. It's something that we don't think about it too much, because we're new to the game, and you just want to get in. You just want to get your feet wet on it. You don't want to like think about that stuff. And nobody likes taxes. Everybody hates to file the taxes every year. So thinking about taxing stock market is already hard to understand. Now you have to also think about the taxes. It just becomes not a lot of fun to do, but it's really important because you don't want to get in trouble because with the IRS, because they're paying the butt. But some of the taxes that you have to consider is your dividends. If you are investing on the index funds, you're most likely going to receive some dividends every 3 months or 6 months, but you're gonna see at the end of the year you're gonna receive some dividends, and you have to pay. That's income, and that's unearned income, and you have to put on your gross income at the end of the year on your tax returns. That's something we don't think. If you're gonna be selling any of your stocks during the year, you will also have to pay taxes if you had a gain on those stocks. Also, if you had a loss, you can actually put those two in your stock in your taxes. But the other thing you have to consider is how long you had the stock portfolio. If you are selling stocks that you bought this year, you want to sell it in the next 4 months, that's considered short-term selling, and that's going to be a different tax bracket that you are going to be paying taxes on. But let's say if you bought taxes 2 years ago, you bought stocks 2 years ago, and then you sell it this year, that means you have 2 years of that you hold those stocks. I mean, that's considered long-term. So anything that is over a year plus 1 day is considered long-term investment, and that is taxed in a more favorable tax rate than short-term. So that's something that you have to consider if you're gonna be selling. If you're gonna be a day trader kind of investor, that's one of the pitfalls that you might not consider. The last mistake a lot of investors are making is that they're not honest with how much hands-on they want to be with their stock portfolio. A lot of them wants to be day traders, but they end up being long-term investors where they just really passive. They get bored after a while of day trading. They see that they're actually losing more money than they are making, so they switch to becoming long-term investors, but they don't have a goal. They never work towards being a long-term investor because their first approach was to be a day trader. Or some investors go into the game trying to be long term and that being day traders, where they are in their portfolios always checking for new stocks or new indexes that they want to buy, and selling and buying the same year, where then now they're not considering that they had to pay taxes for short-term investment, but then they go back and forth. You have to be honest with what kind of portfolio you're gonna be like handle. Also, some investors don't even know if they want to be long-term or day traders, or they don't even know if they're gonna need some advice from a professional that is gonna help them manage their portfolio. That's all that has to be considered when you get into the game, because if you don't know anything about the game, you want to get in, you might need some help, somebody holding your hand to help you manage your portfolio. Some people have read some books or took an online class or went to a school for it, and they have an idea of what to do and they want to do it, but then they don't want to be too much into it. Thank you guys for watching. Hopefully after watching this video, you guys can see the mistakes that I was making as I was a beginner investor. Hopefully you guys can learn from it and don't fall into it. These are some mistakes that you're gonna apply to life in general. If you want to open a business, you have to think about these mistakes that you might run into. You also, if you're going to school, anything, you want to buy a house, everything that you do is an investment of your time and money. So these are some mistakes that you have to think about, that once you jump into your new journey or the journey you're into, maybe you're making some mistakes in the journey you're in, and you want to fix it so you can progress faster. But remember guys, to always keep it simple.